Okay, an informal good afternoon all. We're a little bit early here. I'll introduce myself properly in a second, but my name's Jeremy. And what we're going to do is just watching the participants box uptick at the moment. So we'll just wait until we get a critical mass in about a minute's time, and then we'll get going. So thanks for being here on time. Just getting a few admit messages on my screen as well. Bernard, just give me a thumbs up that you can hear me okay. There you go, perfect. Lights, camera, action, always reassuring. Okay, so still going up. I'll be hitting 50 in a second. Just got to the magic 50 and still headed north. Right, just bear with me 10 or 15 seconds and then we'll make a gentle start. Welcome if you've just popped in. Perfect timing. Here we are, still going. Still a gentle flow, just bear with me. Right, as we approach 12:32, I think we'll make a formal start. So welcome. Let me just briefly introduce myself. My name is Jeremy Smith. I head up the banking and finance division of Kaplan, where we run a whole host of courses, exam and non-exam, for a whole host of clients. And our clients mainly are either directly involved with the financial markets or have activities that spill over into the financial markets. With me today, I've got Bernard. Bernard will be coming on mic in a few minutes' time. Bernard Duffy worked as a fund manager on the coalface for 13 years. He's going to be doing the presentation today before he moved to consultancy and education. He's actually been specializing in ESG since 2006. Not sure I even knew what the acronym meant in those days. And so Bernard is going to be taking us through the slide pack, through the presentation, and also answering questions, which I'll talk about in a minute. Now, this is either a welcome for the first time or a welcome back. Just very briefly to set the scene. Banking and finance at Kaplan run these sessions on a fairly regular timetable. We've been running them since 2020. We pick topical and interesting areas, and so we've had Bitcoin, we've had cryptocurrency, we do economics updates when interesting things are happening in the world, and we'll probably do one of those for our next session as well. But today the theme is ESG. Now, as I say, in a minute, I'm going to hand over to Bernard, but just quickly in terms of housekeeping, Bernard will present for around about 40 minutes, and then we will leave a gap at the end for questions. So technically, this is a two-way audio session, so you can take yourself off mute. If you could avoid doing that during the actual presentation, that would be appreciated, just to keep the continuity going. If something does strike you on the way through that you would like to ask, so always wanted to ask but never dared, then do feel free to pop it in chat. And my job, I'm admin today, so my job is kind of to harness the chat. And so we'll either drop it in real time or we'll pick it up when we do the questions at the end. And then at the end, if you want to either continue in the chat box or you want to take yourself off mute and come on mic, then we'll have a two-way Q&A session at that point to satisfy curiosity. So that's the way we'd like to run things, if that's okay with you. And what I'm going to do now is just hand over to Bernard to get the formalities underway. So over to you, sir.
Great. Thank you very much indeed, Jeremy, and a very, very warm welcome from myself. We have an interesting session lined up for you on developing an ESG mindset and why finance needs it. So just in this first preliminary comments, I'd just like to share with you the agenda we're going to be covering for the next 40 minutes or thereabouts. So developing a critical ESG mindset. What does that mean, and what are the steps involved in developing an ESG mindset? As Jeremy pointed out, I've been involved in this space going back to 2006, and it never ceases to amaze me the steps that can be taken to develop a critical ESG mindset, but unfortunately, we can get bogged down with a lot of the technical detail. Just by way of background, I think I should also give you a little bit of a history of ESG, and then to put it into the context of the fund management ecosystem or the fund management architecture as it exists today, because we're going to see that ESG is permeating all areas of fund management, and that's very, very important. And so we'll spend a couple of minutes on that as well. And then we'll wrap up, bring it back to the training side of the equation, as opposed to the technical ESG side, which is very much looking at the training challenges that L&D people are going to be confronted with, I believe, in the months and the years to come. Since COVID broke out in 2020, a huge amount of my training time is spent in this area. I'd say it now represents about 80% of my time, and we're getting very, very broad, very types of requests around ESG, and I'll share with you some of those insights at the end of the presentation as well, and then we'll open it for Q&A. So without further ado, let's get straight into the presentation. Developing a critical ESG mindset. So what I've done here is just laid out a few what I might call pillars of the steps that are required in developing an ESG mindset. Now, obviously, you're not going to get this in any textbook, so this is purely based on my observation over the last number of years. And the first step is really get your facts right. And this is critical. So in other words, we need to separate fact from fiction in the ESG world. So if I'm asked, what is the difference between 1.5 degrees and 2 degrees global warming? What exactly does that mean? What does that mean? So what, and apart from the 0.5 difference between 1.5 and 2, what are the implications for climate change? What are the implications for global warming of the difference between those two? That's one example. What are carbon sinks? What are carbon budgets? So all of the technical aspects around E, S, and G, we need to be very, very clear. So it is crucial to get those facts right from the outset. And this will help us when we're confronted with step number 2, or what I would call embracing the complexity of ESG, specifically looking at the nuances and the complexity in the ESG world. Now, of course, this world of ESG is laden with ethical considerations, moral considerations, issues around principles. Fund management organizations are no different from a business perspective than any business out there. And we are seeing, in light of what's happened over the last 5 weeks with the Russian invasion of Ukraine, businesses are being confronted with some very, very serious moral issues that they have to confront with. In other words, whether to continue business, whether to continue working in Russia. So what I'm really saying here then is that when we bring ethical, moral principles into the mix, along with the factual evidence and all of the facts surrounding ESG and sustainability, this world is highly complex and highly nuanced. And obviously, we need to navigate this world. And again, some of the examples I will talk about as we go through the session will highlight that to you. But what this is saying, though, is that we need to use this complexity and nuanced to our advantage, and especially when we are trained in this area. The third pillar, or what I might call the third sort of blockage, if you want to use it, depending on how you view the world, are these blockages, or are they pillars, or are they obstacles, is when ESG meets behavioral finance. So in other words, in the world of ESG, we all have baggage, we all have preconceptions, we are all hamstrung by our biases. And what the world of behavioral finance has taught us over the last number of years is that investors make mistakes when they invest. But not only do they make mistakes, they continue to make those mistakes, and they fail to learn from those mistakes. So when the world of ESG and the world of behavioral finance come together, which is what we see in everyday investing activity, this is very, very important, because we do have biases, specifically ESG biases. We do use shortcuts to arrive at ESG decisions. So you can see why we need to be very aware of these biases and preconceptions, but equally, we have to be very aware when we see them in others. And what I'm really saying there is, of course, where clients bring their ESG biases, preconceptions to us, because we know as investors, we're not moralizing to the client. The client is telling us what they want to exclude, what their exclusions are from their portfolios. But of course, there are biases and preconceptions involved in all of this. So we need to understand what are the drivers of those. And step number 4, which again potentially is a blockage, is don't ignore the politics, or maybe we should say don't ignore the politics and the geopolitics of ESG. So in other words, we've seen some very good examples of that recently. Only this week, we saw the publication of the IPCC report into climate change. So that's the Intergovernmental Panel on Climate Change. And we saw that that report was delayed because all of the political wrangling that was going on behind the scenes regarding commitments by nation states in terms of what they were going to do to reduce their dependency on fossil fuels. So again, the politics of ESG and the geopolitics of ESG, very, very important to understand as well. And of course, again, referring to Russia's invasion of Ukraine, there will be some investors out there who will say, well, hold on a second. There are a number of authoritarian states that have failed to condemn Russia's action. So that means, in effect, that could influence their investing behaviors. So in other words, what I'm really saying is that all of this is highly complex, highly nuanced, very, very political. And of course, we all bring our baggage to the table. And the last pillar, or the last blockage here, regards this word that we call washing. So in other words, we see a lot of greenwashing, and we see these taxonomies that have been developed in recent years in order to eliminate that, what we call greenwashing. But we see other types of washing as well, referred to as transition washing, companies exaggerating how far they are on their transition pathway to net zero, and of course, competence washing as well. So what this slide really does here in this presentation is really set the scene for developing a critical ESG mindset, and of course, why finance and financial professionals need specific training in this area. So if we think about the history of ESG, and if we frame it in an economics context, we see major economic paradigm shifts that happen every 30 or 40 years. And of course, we've seen one of the most influential fund managers in the world just a couple of weeks ago state that we're at the end of globalization. Mr. Larry Fink from Blackrock, and I understand we may have a couple of Blackrock people here this afternoon as well. But basically, this was a pretty big statement by the chief executive of Blackrock, because he was actually saying that this is an economic paradigm shift that we're seeing in the world with the potential end of globalization on our doorstep. But I believe genuinely that ESG represents also an economic paradigm mind shift as well. So if we go back and consider the history of corporate governance as applied, certainly in the Western world for the last 40 to 50 years, it's been very much influenced by this Nobel Prize-winning economist, Professor Milton Friedman, who gave an interview to the New York Times way back in 1970. And if you'll excuse me just reading out his quotation here, you can read it yourself. But what he said and what influenced the practice of corporate governance in America and in the Western world ever since the 1970s is this particular statement here. Few trends could so thoroughly undermine the very foundations of our free society as the acceptance by corporate officials of a social responsibility other than to make as much money for their stockholders as possible. This is a fundamentally subversive doctrine, meaning, in other words, any other motivation other than to maximize shareholder profits is basically anathema, is basically going against the very fabric of what American capitalism is all about. And of course, we know that Professor Milton Friedman was an arch libertarian. So this concept that Friedman promoted has been challenged in recent years. And if we fast forward to 2020, specifically 50 years after that seminal article was written in the New York Times, the New York Times invited top chief executives from American corporations to voice their opinion on that seminal article 50 years after it was written. And again, with all full due respects to Larry Fink, I chose his quotation here because I think it's very, very instructive. In today's world, a greater sense of responsibility from business is not going to undermine free markets, as Friedman suggests, but is actually essential to preserving and strengthening them. That's not just my personal view. It's what BlackRock's clients are telling us. So in other words, a sea change in attitude has occurred. And when we see these sea change in attitudes, it is indicative of an economic paradigm shift that is occurring, that is affecting not just corporate governance, but also economic governance as well. And we see a lot of concepts around ESG, like, for example, the circular economy, that are now becoming part of the economic, day-to-day economic narrative. So just to finish off on looking at these economic perspectives, I just go down to the fourth individual here, again, another Nobel Prize-winning economist, Professor Joseph Stiglitz from Columbia University. He also voiced his own opinion at that same round table in September 2020, 50 years after the original article was written. And what Stiglitz said was that Friedman's essay and his other writings on the subject were unfortunately enormously influential. They helped change not only the mindset of the business community, but also laws and norms on corporate governance. In the presence of imperfect risk markets and incomplete information, that is, always, firms pursuing profit maximization did not lead to the maximization of societal welfare. So again, there's a lot in these quotes here, but all very much focusing in on ESG and sustainability. This other Nobel Prize-winning economist, Robert Lucas, again, was very much in the Friedman camp. So to give due respect to Friedman, but But he was basically saying in this particular quote here that he gave a speech to the Federal Reserve Bank of Minneapolis. He basically was simply saying here is that questions regarding distribution of wealth really are outside the realms of economics. Economics really shouldn't bother itself with questions of distribution, because his view was that a rising tide, a rising economic tide, lifts all boats up, which means that poor people will be bootstrapped with this rising economic activity over time. But frankly speaking, any economist these days would challenge that rising tide of economic growth simply because we're coming up against planetary boundaries. The planet cannot cope with this continuous economic growth ad infinitum. Currently, we have broken through 4 of the planetary boundaries as specified by the Stockholm Resilience Council. So meaning, in other words, there is a limit to how much economic growth we can continue with. So again, just framing the current debate around ESG in some broader economic context is very, very important, because again, we are witnessing a paradigm shift. Just moving on here, a little bit of the history. Now, I'm not going to speak on each particular point here. I'll just take the start and the end points here. But if we go back to 1971 here, the first mutual fund with specific ESG characteristics was launched in the United States, and basically decided or had as its mandate not to invest in armaments, weapons manufacturers. And this was in response to the Vietnam War at the time, which, obviously a lot of people, were repulsed by. So, this really was the first ESG fund. But of course, ethical, moral investing goes way, way back to the 19th century. In fact, even the 18th century, when the Quakers in Northern Europe refused to invest in any business that had anything to do with the slave trade. So that was really the start of exclusionary investing, as we call it today. And of course, in the early 90s or the early 80s, then we saw ordinary citizens, ordinary consumers boycotting goods from South Africa. And of course, major institutional investors boycotted South Africa in response to the apartheid regime, and that actually contributed significantly to the abolition of the apartheid regime. So again, we saw lots and lots of developments, and of course, 2006 was a seminal year because the Principles for Responsible Investment was launched in New York by the United Nations, and of course, we've seen many developments since then. So 2006 is recognized as the year when the acronym ESG was coined. So ESG, in effect, has been around since 2006, but I would argue really over the last few years, it's taken on unstoppable momentum, which we will see shortly. But again, 2015, a very, very important year because we saw the Paris Agreement, COP21 in Paris in 2015, where it was agreed to limit global warming to no greater than 1.5 degrees above pre-industrial levels. And of course, the publication of the IPCC, that is the Intergovernmental Panel on Climate Change report, only released on Monday of this week, reiterated that commitment. But of course, as I mentioned earlier on, a lot of political wrangling going on behind the scenes, which really highlights the politics and the geopolitics behind ESG, which analysts, fund managers are obviously aware of, but can present hurdles in our portfolio management. Then, of course, in 2015, we saw the launch of the UN SDGs, the Sustainable Development Goals. And I'll get you to do a little exercise on that in a few minutes' time, just to get us engaged. Being a trainer, we we get paranoid if we're speaking for too long. We like to get the engagement of our audience. So I'll get you to do a little exercise on the SDGs. So the SDGs are a very, very important framework that have formed the basis of a lot of what we call impact investing over the last few years, meaning, in other words, it's a framework that investors can use to have an impact on the 17 goals that were set out and laid out by the United Nations. And again, you should get a little bit of fun from doing this little exercise. So again, this isn't an exhaustive list, but it just gives you a little bit of a flavor as to where we have come from and potentially the direction of travel in the future.
Just to set expectation, Bernard, there are no prizes at stake for the SDG quiz. It's just pride. It is just pride.
Thanks for pointing that out, Jeremy. Fantastic. Good. Now, of course, for some of you, this is bread and butter material here, the what, the why, and the how of ESG investing. But for those of you who don't come from an investing background, it is important to understand that we do have, we do have frameworks, and we do have a lot of standards and frameworks that have been built around ESG and sustainable investing over the last 20 to 30 years. We don't have time to go into them here and now, whether they are investing frameworks, whether they're accounting frameworks, but this really does give you a very good insight into what ESG is about. So ESG, as you know, environmental, social, and governance. And of course, it's all about the assessment of material risks that emanate from these non-financial issues, because environmental, social, and governance are non-financial issues, but they can have serious financial implications for the corporation. So therefore, we're looking at those issues of significance, or what we call material, and that has given rise to this very important concept of materiality. And materiality is a very dynamic concept because, of course, corporations have to look to the future to try and understand what could become material in the future. So meaning, in other words, a few years ago, biodiversity wasn't really on anybody's radar screens, but today we need to understand the impact that corporations have on the natural world and how dependent some sectors and industries are on the natural world. So this concept of dynamic materiality, very important. Social, everything around the human capital management. So again, we go back and we might sort of say today, well, why wasn't there more women on boards of directors? Why weren't there more women in senior management positions going back 20, 30 years ago? It seems almost strange to ask that question today. But ethnic issues around board representation, and of course the fund management industry has been under the scrutiny in recent years regarding ethnic representation. So meaning, in other words, it's not just environmental, it's issues around human capital management and of course governance. But what we do know is that the three pillars of ESG or sustainability are: number one, economic growth. We need economic growth. We need companies to generate profits. But that's only possible over the long run if it's accompanied by environmental protection. So in other words, we can't just continuously hope to grow our economies without taking into consideration the limits to growth. Meaning, in other words, we need to do this in a very responsible manner to make sure that we are not ruining the planet for future generations. And of course, that should also include social progress, social inclusion. And again, that's a very hot topic at the moment in the context of leveling up of different regions, whether that be in the United States, whether it be in the UK, Europe, or wherever. So the three pillars of sustainability are economic growth, environmental protection, and social inclusion and social progress. And that has then led to these accounting frameworks called triple bottom line accounting, meaning people, that is the social, planet, the environment, and of course profits, which is the economic governance around how companies operate, are managed, and are overseen. So this triple bottom line accounting is something that we're going to have to pay a lot of attention to, because with the arrival of international sustainability standards, we are going to be paying as much attention to these sustainability issues as we have traditionally done to standard financial issues that we would find in an income statement, a balance sheet statement, or a cash flow statement. So all of these material issues that are considered to be non-financial are now, we are beginning to recognize and acknowledge, have serious financial consequences.
Bernard, can I drop in with a quick question? Sorry,
please, at any stage,
I shouldn't be asking these, but I'm going to.
No,
obviously,
please.
on the previous slide, we've got these frameworks, and obviously you're involved in ESG training. You'd expect me to ask this, but do training providers have a part to play in this?
Oh, 100%, and I think we'll see that at the very conclusion of this shortened presentation. So, in other words, I would argue that the quality of the ESG training curriculum is actually going to differentiate fund managers, banks, whether they're investment banks, corporate banks, private wealth managers, investment managers. It's really going to differentiate laggards and leaders going into the future. This is going to be a key issue for the financial services industry. And when I say their training curricula, I'm not just talking about new graduate recruits. I'm talking about all the way up to the board of directors. This really is a whole of organization approach, I believe, that financial institutions are going to have to take regarding ESG. It's a whole of organization, all the way, and it's been a while since I worked in a fund management organization, but those days we used to have the post boys. But what I'm simply saying, who used to bring around the brokers research every morning. I don't know if they still exist, but what I'm really saying is that, all the way from the most junior people to the most senior people, this is a whole of organization attitude, because it impinges very much on the culture and the values of an organization. So this is inextricably tied in to the actual culture and the values that a financial institution will look to espouse and to project into the future. So 100%, and I'll come back and elaborate on that later on. Jeremy.
Okay, super. Sorry to jump the gun.
No problem. It's a very good question, and of course, we can get bogged down with all of the technical issues, or accounting or economic or financial issues around ESG. But of course, the bottom line here is learning, training. This is an evolving discipline. It's very evolving. Nobody can actually sort of state that, we have the monopoly of information in this area. So it is really evolving, and it's got further to evolve. Now, for some of you, this is pretty familiar, and for many of you, it will be sort of not quite rocket science, but I'm not going to get bogged down in it. But really, what this chart really shows is the ecosystem, the fund management ecosystem today as practiced, specifically in the West, meaning we have passive indexation called bulk beta. We have then liquid smart beta, which again is, a more sophisticated form of indexation. Then we have what we might call liquid alpha, which is what we traditionally get with active funds. And then we have the alternatives that we find in the illiquid space. So what these four headings are saying is this is really driven by levels of efficiency, or these are potential solutions for the end client. Some clients will want a passive indexed approach. Some want something a little bit more than that, which is where smart beta would enter the equation. But of course, all of these four segments here, they all have different return drivers, whether it's an equity risk premium, whether it's an aspect of skill or style attached to it. So meaning the return drivers, are all different. But the key point of this chart, without getting bogged down in any, boring detail, is that ESG is permeating all areas, right across these areas. So ESG indices in what we call classic passive indexation, ESG factors in liquid smart beta. So in other words, a carbon tilt, a gender tilt in a specific fund. Liquid alpha, our traditional active management that is trying to outperform a benchmark. We're seeing ESG activism, ESG stewardship, engagement, which hopefully will lead to a revitalization of active fund management. And then, of course, in the illiquid space, whether it's real estate, private equity, commodities, debt instruments, whatever, we're seeing ESG permeate there as well. So what I'm saying very, very simply here is it's permeating all areas. And this is specifically looking at the fund management area. But if you're a banker, I've just finished a major program for a European bank, and that program was titled The Sustainability Banker, where we were looking at how to position a lot of these sustainable finance products with their corporate clients. So in other words, sustainability linked bonds, sustainability bonds, social bonds, green bonds, et cetera, So meaning this is very fund management centric, but of course, this has got huge implications for the banking sector as well, in terms of the sell side, meaning sustainable finance. So not wanting to spend too long on this, but I do think it does sort of capture the way that ESG does represent a paradigm shift, and it is permeating all aspects of finance. Now, I threatened you with a little exercise, and here's the little exercise we're going to get you to do. So I'm going to really call on Jeremy's help here, but I'll just set the scene, I'll set the question, and then I'll pretty much hand it over to Jeremy, who will curate the question or the answers in the chat function. So we'll encourage you, when I give you the question, to go into the chat function to give us your answers. Now, what is this saying? Well, we mentioned in the history of ESG, we go back to 2015, whereby the United Nations, with the encouragement and the agreement of all of the member nations of the UN, signed up to the SDGs, which are 17 sustainable development goals, with a target of 2030 to accomplish these. Now, when these goals were set, it was all very much in the realm of development economics, because they were targeted mainly at nation states. So in other words, this is classic development economics. So these 17 goals, very interconnected, which we'll see shortly, but they were very big macroeconomic objectives: elimination of poverty, elimination of inequality, etc., etc. But in recent years, we've seen funds, corporations, and even real products called sustainable finance products embrace the SDGs as objectives. And this is what, in essence, the exercise is about. But first of all, as you can see from this very, very nice diagram, what are the 17 SDGs? Well, here they are. Now, obviously, I don't expect you to remember these, but here's the 17. Some corporations might adopt 3 or 4 of these and link those to their sustainable performance targets, and then set key performance indicators, KPIs, around these sustainable goals. But as you can see on the right-hand side, 9 of them, where I say yes, are environmentally related. So they have a direct connection to environmental issues, climate change, global warming, etc. Now, you might wonder what the exercise is, and the exercise is on the next chart. But I will come back to this to show you and to ask you the question. So what is the question, first of all? I take my hat off here to Blackrock, and as I mentioned earlier on, there may be a few representatives from that organization here today. But they carried out a study in, I recall it was June, July of last year. And what they looked at was the 17 SDGs and what the adoption of those 17 SDGs meant for the financial performance, yes, please, the financial performance of those corporations who adopted those SDGs as a target. And what they found was something very, very interesting that I find it interesting enough to want to share it with you. And by the way, this is not an advertisement for Blackrock. It's just simply because it's a very good study, and this is the type of research that we're beginning to see come out of this space called ESG. So what they found was a 70% connection between the UN SDGs and corporate financial performance. Now, I won't go into the statistical detail or any of the detail behind the studies, but I would, if you're interested, I would recommend you read it. But this 70% connection was very, very strong and very, very, obviously, I think it took a lot of people by surprise. And I wouldn't be surprised if it even took the authors at Blackrock by surprise. So what I want you to consider and actually tell us is which of the 4 of these SDGs, which I'm going to put back on the screen now shortly, do you believe constituted more than 50% of this explanatory link between the corporate financial performance and the SDGs? Now, just by way of background, they plotted something like 900 sustainability accounting standard board materiality indicators to the SDG country indicators. So it was very technical what they'd done, but we won't get bogged down with the detail of that. But what I want you to consider is which of the 4 of these out of the 17 do you believe constituted over 50% of the explanatory reasoning or rationale behind the link between the corporate financial performance and the country indicators? So meaning, which of these 4 were the most important? So I'll hand it over to Jeremy there, because Jeremy is going
to... the admin man. I've got to capture the voice of the group here. So
Absolutely.
I think I might make this slightly easier, actually. We're looking for the top 4 in terms of impact on corporate performance. I think what I'd like you to do in chat is just pick your top 1. And then we'll see if we cluster around the top 4, if you see what I mean. So if you'd like to just take some time to cast your eyes down the 17, pick your number 1 in terms of impact on corporate performance. You can put 4 in if you like, but we're going to get quite a spread of answers here, and I'm going to try. Oh, blimey, we've got 4 coming in already, 2. Good stuff. Okay. Let's have a look. Keep them coming. 13 seems to be a favorite at the moment. I'll do a quick scores on the doors. Okay. Right, I will pick up any more that come through. I'm going to scroll down chat. So Bernard, I think the voice of the group is this 13. 13 has come out as a very definite favorite. Followed closely by 12, I would say, is the next most popular response. So we've got climate action, responsible consumption, and production. They're the very clear top 2. Let me just see if I can find a consensus for at least the 3rd one. I think 9, definitely, actually 9 would be in there as a joint 2nd or a 3rd. And then it all gets a bit disparate, actually, to be honest. So let's work with those. Let's work with those, shall we? So there you go.
That's exactly what I expect. But what is very, very interesting in audiences and group training sessions I've delivered this to over the last 12 months. So again, compliments to Blackrock. And I always acknowledge it is Blackrock's. It's not my study. Just from a copyright perspective. But what I found is that what is fascinating is that it's younger people who tend to get this rather than old guys like me. Let's put it like that. So there is definitely a bias towards, and that's interesting in its own right. But let me tell you, well done, first of all, congratulations. 12 is very important. SDG 12. That is responsible consumption and production. So in other words, that word responsible, but consumption and production, very important. And that really slaps in the face of this continuous GDP growth ad infinitum. But the other three were, wait for it, consecutively, which is quite interesting. They were all bunched, 6, 7, and 8. So 6, 7, 8, and 12. So 6, clean water and sanitation, 7, affordable and clean energy, and 8, decent work and economic growth. So 6, 7, 8, and 12 accounted for 50% plus. Now it was concentrated in certain industries, and I won't bore you with the detail. I would refer you to the study itself. It is a very interesting study. So to conclude this then, the second, and I will answer that. What are the implications of BlackRock's findings for investors and corporations? Well, let me just quickly tell you what it is. What BlackRock concluded was that traditionally, those investors who embraced the SDGs as a framework were traditionally called impact investors. These would be the type of investors you would find in private banks, family offices, charitable organizations. So for example, the Wellcome Trust in the UK is a very good example of an impact investor. They want to use the great returns they generate to fund animal and healthcare research. So they want to have an impact with their investing. But traditionally, the SDGs, that's where you would find them. But now we're seeing the SDGs fully embraced by ESG integrators, meaning these SDGs are being fully integrated into investment processes, which I think is a very, very interesting conclusion and observation. So that's the implications for investors, which is the second question. And then for corporations, more and more corporations we will see, embracing and will embrace the SDGs as a framework in the future. So what started off as a big macroeconomic theme or framework has now permeated into the fund management, the banking, the investing, the corporate world, which again is very, very interesting. So I thought that would be an interesting exercise. And to finish off, because I am conscious of time and I would definitely like to leave it, I'm sure Jeremy would like to open up for questions as well. Despite the increased attention that we're seeing in ESG, L&D professionals do face tough challenges in this space. So number one, how to define and prioritize the skills and the values associated with ESG. And this is obviously no easy task, given the myriad and the plethora of challenges associated with ESG analysis and investing. It will certainly involve L&D professionals working very closely with the front office, specifically in the area of fund management. But of course, if you extend it then into the worlds of banking, L&D people working very closely with the bankers, frontline bankers, which is what they're used to doing anyway. But this is such a new area that it really will differentiate top curricula from what you might call, just for want of a better word, and I do apologize for using the word, stale curricula. Let's just run it out again next year and next year, because the evaluations are good. So this is very, very dynamic. Of course, it's not the job, of any fund management organization to moralize to its staff regarding ethics, morals, principles, because ultimately that is the client's decision. But of course, it's going to be incumbent upon client-facing staff, whether that's in the banking sector or in the fund management sector, to really understand what it is that's driving these decisions by the investors, whether it's a pension fund, a sovereign wealth fund, or whatever. The second challenge then is how to integrate them into the training curricula from the board all the way down to the graduate recruit. So ESG training, as I mentioned earlier on, really is a whole of organization issue and challenge. Every member of staff will need to understand the meaning of ESG and sustainability, as this will help define the culture and the values of organizations going forward. And last but not least, how a failure to do so will undermine the future of the investment industry and potentially your organization. And I don't say that lightly. I mean, I'm 41 years in the fund management industry, and this is as momentous a paradigm shift as I have seen, and we're seeing that definitely in the training and the L&D world. So basically, the failure here is not an option, really. It definitely is not an option, either for the industry generally or for any organization. The quality of your ESG training curriculum will be a key differentiator going forward, and it could determine whether you will be a leader or a laggard in this fast evolving discipline. And on that point, I'll hand it open to the forum for Q&A.
Super. Thank you, Bernard. Thank you. So yes, I'm just conscious of time. We've got 9 minutes left. And so we would like to open up the floor to questions. There's obviously, we can do this in both of two ways. If you want to type a question into chat, then I'll handle that and obviously pass it across to Bernard, or do feel free. It's two-way audio, so just to come on mic. I noticed a lot of you have got your videos on as well, which is great. And so we can obviously have a two-way chat. So
thanks.
What I'll do, Jeremy, sorry, I'll just stop sharing and just go into gallery mode, if that's all right.
Yeah, no problem.
Thanks, both, for this wonderful presentation. Definitely very helpful. Quick 2 points from me, 2 questions from me. So when we talk about this 3 triple bottom lines, so just one aspect, should we have like technology as a 4th one? Why this question? Because in current time, the technology is in boom, like cloud, blockchain, and quantum computing, and they are thinking about the climate as well, because they have the positive impact on the climate. So how you think about their participation in the climate and the ESG? My second point is a basic win, which I have been thinking from last couple of days. Currently, we have like from last 45 days, we have war between Russia and Ukraine, and definitely there's a big impact on climate. If I'll talk about the climate sustainability. So what's your takeaway on this, that how long time will gonna take to offset this impact what we have in last 45 days? So these 2 questions just wanted to ask.
Okay, yeah, well, 2 very good questions, and the first one is probably easier than the second one. We're now beginning to see a lot of technology being applied to this area called ESG and sustainability. That's been witnessed in the context of AI, artificial intelligence, neuro-linguistic programming. All of this higher level technology, algorithms are being brought to bear in this space, because the amount of information is just simply too much. It's simply too much. And we are highly likely to see this come into the auditing profession as well, especially around sustainability accounting. So a very, very good question. And the answer is, you're right. We are beginning to see technology, and that's only going to go one direction, and that's up. Second question, far more complex, but yes, the answer to the question is that this is going to accelerate the transition to renewables. So what we're seeing with this dreadful situation in Ukraine is we're going to see this accelerate the transition to renewables. even though we are still dependent on oil and gas, and in some nations coal. So that transition will be accelerated towards renewables. And of course, a country like Russia, its very economic existence is now threatened. But that will not be the only country whose economic existence potentially will come under threat in the years to come. Because if anything positive comes out of this horrible situation that we're witnessing, will be this rapid transition towards more sustainable sources of energy going forward. So hopefully that helps.
Yeah.
And I've got another couple lined up in the chat box for you, actually. So Jean-Eric, thank you very much for your question. Why is the rhetoric usually around the ESG factors that impact businesses? What about the rhetoric being the ESG factors that businesses can impact?
Yes, good point. And this is actually a very topical issue at the moment, because we see what we call ESG scores and metrics coming under huge criticism. So in other words, this double materiality, not just the impact that that companies can have on ESG, but also the impacts that ESG can have on companies. So in other words, this is a huge area of focus as we speak. Now, if anything, what this really is going to encourage is far more original, unique research and proprietary research, specifically by fund managers, into devising and coming up with their own scores, as opposed to relying on, external parties. And of course, what it all could lead to is some type of standards around how we measure both the impacts that ESG have on companies, but also the impact that big corporations have on ESG. So all I'll say there is that with the arrival of accounting standards, specifically around sustainability accounting standards, with far greater oversight of what we call these ESG scores, I believe that this, especially in the area of data implications, effects, ramifications, we will be seeing this in a more two-way lens, meaning there is a lot of rhetoric, there is a lot of nuance, there is a lot of greenwashing, but I do believe that is going to be outlawed. The EU taxonomy is actually looking to address this in many areas, but when we see the UK develop their own taxonomy, which is actually happening, potentially Asian countries, and hopefully eventually the United States, the momentum, as I say, is one direction. There will always be greenwashing, there will always be rhetoric. We can't get away from that, but I think we'll be able to see through it with these standards that are going to be developed, and probably more perfect, for want of a better word, scoring systems around this.
Perfect, thank you. Hopefully, Jean-Eric, that answers your question. They're all coming in now. I think we're going to have to do a first come, first serve basis, and then we'll see how far we get. Bernard, so let's have a look.
I did see a question there in terms of what do you think is the best way to go about a type of a whole of organization.
Educating the workforce.
Yes, exactly. What I'm finding is that if you go into any group and you start talking ESG, there can be issues there, simply because it's too much. So what we usually do is we start with the principles behind sustainability. Sustainability has been with us for 30, 40 years. Very forward-looking corporations have been doing this. So basically, there are 4 very clear, easily defined concepts and principles around sustainability. That has to be the starting point. And once delegates, participants understand that, ESG is easy. ESG is easy. They can navigate the world of ESG quite easily, because ESG, it's an acronym that was devised by the UNPRI, and then it was adopted by the fund management and the banking community. It's nice and easy for those people who are working in it, but for somebody who comes into this, especially for somebody who's not involved in it day to day, they need to go back to first principles. And what I'm saying is that first principles here are the principles of sustainability. And there's 4 very well-defined principles around that. And most people understand that. So that would be my advice there.
Lovely. We'll do one more, if that's okay, and then
Please.
we'll call a close. This one's close to our hearts here. Investment managers, this is from Helen. Thank you very much. Our big graduate recruiters. Will ESG force a tide of change and start recruitment from wider social backgrounds such as A-levels, O-levels, GCSEs?
Yeah, that's a very good question. And, it is fascinating to note classes that I do go into and deliver to younger people. They're very engaged with all of this. And I do believe that, yes, the fund management community and the banking community, does really have to broaden out that sort of recruitment, because there's nothing that divines why a fund manager and analyst should come from either an economics and engineering, a liberal arts background. You actually think about what young people are doing these days in terms of their own personal investing on these platforms. Some of them, I would almost guess, are turning into very good personal fund managers themselves, and that's been encouraged, of course, because they have to take responsibility for their own defined contributions into their pension plans. Whereas before it was pretty much all done for us. So what I'm saying is that I do believe that there's a lot of very talented potential fund managers out there who don't come from the traditional talent pool of universities in terms of degrees in economics or engineering or history. But again, that's going to be a big challenge for human resources professionals going forward. So again, seeing the world through this lens is going to be very dramatic, and it's going to have huge implications going forward. I was just talking to one of my own family members, my daughter, and she says, she just said, in passing, she knows I'm involved in this area, and she says, I dislike the fact that China hasn't actually condemned what's happening in Ukraine at the moment, and she's going to look to her pension contributions and make sure that she's nothing to do with investing in China.
Bernard, I'll tell you what I'm going to do. There's only one question that's been left unanswered, and I feel bad about that. It's like the end of question time here. I'm going to rush you. But if we could just deal with the last one, then I think we've satisfied most curiosity here. So very quickly, while ESG is ongoing continuos, will natural calamities be covered as well?
Now, when we say natural calamities, what exactly do we mean by that?
My guess would be, Harrenenden, if you could type it. There you go, online. Thank you.
Something like the 2004 tsunami or any of the huge impacts that's happening, like the earthquakes, etc. So will that be a part of the ESG platform, or that's going to be a separate one?
Yeah, absolutely. It's like everything else. When it comes closer to the West, to the developed worlds, we tend to sit up. Meaning, if a tsunami happens in Southeast Asia, it's horrible. We sympathize. We send all of this fantastic charitable donations, but it's so far removed from our experience in the West. That is changing. If you read about this climate science in detail, you've probably heard about the Doomsday Glacier. They're talking about this Doomsday Glacier. It's called the Thwaites Glacier. And it's melting at such a dramatic rate that it potentially will cause sea levels to rise by 2 feet within the next 10 years. This glacier is the size of Florida. not only are they basically saying that sea levels are going to rise by 2 feet, but what's going to happen is it could give rise to a huge tsunami that will cover North America and Europe. That is pretty scary. If that happened, obviously, and sea levels rose to that extent, that focuses people's minds in the West and not before time. Because, of course, earthquakes, tsunamis are something that happens on the other side of the world. And of course, we're very good in sending charitable donations, etc. But if we're then asking for charitable donations to come in from Southeast Asia because we've been covered in this massive tsunami, this is when we do have to really sit up and listen. And it is happening. And we all have existential risk from this. Make no mistake about it.
Lovely, thanks.
And sorry to finish on that very pessimistic note, but I mean, that's the reality of climate science. That's the reality.
Super. Thank you, Bernard. Yep. Okay, sorry, I was getting another question coming in there. So I'm just conscious of time, and if anyone has taken a lunch hour, that we are overrunning on our lunch hour. So hopefully, insofar as we could, that satisfies the curiosity that's come through. So really, my last job is just thank yous and tidying up. So Bernard, thank you for coming in and doing the session. Really interesting. Thank you for everybody that dialed in, and I hope you've also found it interesting and useful as well. I don't know whether Bernard, actually, you can share that last slide just for a quick tidy up.
Oh, sorry.
That's all right. While Bernard puts that up, I've just popped a link in the chat box. We will be following up after the webinar with just an email follow-up. Within that, you'll get a recording. And so if you do need to go back, I did have one or two people come through and say they had a sound issue, I think particularly with Bernard's line, but it was all very clear to me. So it will all be clear on the recording. So apologies if you did experience any sound issues, but the recording actually will be clean because it should be what I can hear, and I could hear everything. So we will send a recording round after the event. We'll also send around a short survey. We always like to do more of the goods and less of the bads. And that's actually the link that I've posted into chat. So if you do find yourself with 5 minutes now and you want to fill in that survey, then please do. Otherwise, obviously, it'll be coming around with an email. So that will be the follow-up on the session. My contact details are up on the screen. And so if you do find that you've got other questions or you'd like to know more, or just more broadly, you want to know what banking and finance can do for your organization, then please do feel free to get in touch. And with that, as I say, I hope you've had a good session, and I think Bernard and I will now wish you a good rest of your day and sign off. So nice to see you. Thanks for coming, and catch up soon.
Thanks for your attention once again. Thank you. Bye-bye.